Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, less than 1 week before the June 1st debt ceiling where we hit our limits, and Speaker Kevin McCarthy says there's no agreement as of now. How can we benefit and make money over Washington's ineptness in politics? We'll tell you how. And tonight, we'll be finding out if the economy will be going into a recession. Should we invest for the next 12 to 24 months and more, because we're going to be talking to Vahan Janjigian, former professor of finance at Boston College, and now he's the chief investment officer at Greenwich Wealth Management with over $2.2 billion of assets under management. I'm Andre Laborde. We've got these stories and more. So sit back and relax, and let's have 30 minutes together. It's Friday, and it's time for Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. I'm Andre Laborde for this Friday, May the 26th. Well, at this moment, the raising of the debt ceiling hasn't not been reached. Now, we know it will because both sides know it has to get done. But will it be done by June the 1st, when the government runs out of money? So as you can see from this timeline, this weekend will be crucial. But until they do, how would you like to make some money out of this problem? That we know will get raised, but at what date? Now, this week, the rating agency Fitch put the U.S. on a negative watch. Well, this is different from the downgrading of U.S. credit, but does continue in keeping Wall Street on edge, and it gives financial hosts, well, like yours truly, always something interesting to report. Well, the last time the U.S. was downgraded by Fitch, the same rating agency, was in August of 2011, when we were going through this same process. Notice on the chart how the performance of Wall Street, the bond market, and even gold performed on the first full day of cuts. Well, so here's how we can possibly make money off of Washington's ineptness. Now, on average, banks are paying about 0.4% for the use of your money. Now, remember, this is the median, so half of you get more, half of you get less. The White House and the Speaker will make a deal, but will it be before Janet Yellen says we'll run out of money on June the 1st? So, as you can see, this year we've taken in revenues of about $2.7 trillion, but spent about $3.6 trillion. Now, no business nor household can sustain these percentages over a long period of time. The bond market, it's jittery, and it's translating into short-term T-bill bonanzas. Now, these are different from the 2-year, the 10-year, or even the 30-year Treasury bonds we normally show you. But take a look at what the government is paying for your money to use for just 1 month, over 6% yield, and for 6 months is just over a 5.4%. Now, these yields are going to be decreasing once a deal is made, but if you lock it in before the agreement for the month, 2 months, or even the year, you're going to be getting over 5% interest, rather than the average of about 0.4% interest from your friendly neighborhood banker. Well, how did our money do this week? Tech stocks led the week with the sector up 5%. And top stocks for the S&P were tech and discretionary stocks. They led today. And the S&P 500 turned positive for May. It was the Nasdaq's 5th straight weekly gain. And the laggards in the S&P were utilities and the energy sector. Well, this week, the Dow Jones, they closed just under 1% for the week. And the S&P 500, they closed today just up 1.5% for the week. And the Nasdaq, they closed today at just over 2.5%. Well, are we going into a recession? And will the Fed's continuing of raising interest rates bring more problems to regional and larger banks? Let's talk to Vahan Janjigian. Vahan is a former professor of finance at Boston College, and now he's chief investment officer at Greenwich Wealth Management with over $2.2 billion of assets under management. Hi, Vahan. Welcome to Wall Street Wrap-Up.
Thank you, Andre. Thanks for having me on.
Vahan, it's no secret that the Federal Reserve wants to get back to a 2% inflation rate. And right now we're still at about a 5.5 or so inflation right now. Do you think in June that with the next meeting at the Federal Reserve, they're going to continue raising interest rates, or do you think they're going to after 10 straight rises, they're going to pause for a bit?
Well, I certainly hope they don't raise interest rates anymore. I mean, they've already caused a tremendous amount of havoc. They're responsible for causing the banking crisis, for example. So I think it would be a big mistake for them to continue raising interest rates. And as you said, their goal is to get inflation down to 2%, but I actually think that's not a realistic goal. If you look at the history of inflation throughout time in the United States, inflation tends to run somewhere around 3.5%. So if they were to get it down to 3%, I think that would be a great achievement. That would be a win as far as I'm concerned. I think it would be basically taking too much of a risk in killing the economy to try to bring it down to 2%.
Yeah. The Minnesota Fed, Neil Kashkari, was saying that they may go ahead and pause, but he really wanted to emphasize that by no means would they be anyone thinking that they're putting a stop to the raising of rates.
Well, the Fed is talking about that pause, as you said. Some people are referring to it as a skip rather than a pause, because a pause implies that that's the end. They're not going to raise any more. The economy is actually slowing. There are some things that look strong in the economy, like the employment market, and I know the Fed is concerned that the employment market is perhaps too strong and fueling inflation, and they would like to see employment weaken a bit. But I think that's a dangerous game, and the employment market is actually not as strong as it looks. So, for example, we've already seen a lot of technology companies announcing layoffs and also a freeze on hiring. Now, these are very, well-paying jobs. And if you look at what's going on with non-farm payrolls, most of the gains are coming in things like leisure and hospitality, which don't pay nearly as well as technology. So I'm not sure it's a good thing that we're already trading high-paying jobs for lower-paying jobs. The jobs market is really not as strong as those employment numbers indicate.
The labor participation rate, I think, is like at around 62.5%. And one of the things that I noticed for the last jobs numbers was that it was the prime age of the worker was going down.
The participation rate, as you pointed out, has been extremely low. Mm-hmm. It has ticked up a bit recently, and that's certainly a good sign. It's certainly good to see that more people are looking for work. And if we indeed do have a labor shortage in this country, as the Fed claims, then getting that participation rate up would be certainly a good thing. It would be one way to address that labor shortage. But another way is to increase immigration. Now, I know there's a lot of opposition to that, but immigration would really go a long way in easing that labor shortage. And in my view, the best way to address any labor shortage is to increase immigration.
Interesting of what type of immigration, just like what you're talking, because like those that are coming over the southern border right now, I'm sure they're finding employment in the service sector and the sectors that you were just talking about earlier, waiters and cooks, and those are for the HB1 visa that a lot of tech companies may be looking for and such. Mm-hmm. Those are taking a specific kind of skill.
Well, let me clarify my comments. So when I'm talking about immigration, of course, I'm talking about legal immigration. I think, we need to be, very careful and make sure that we don't have illegal immigrants coming into this country. But our immigration services have been really backlogged, so it's been very difficult for them to allow legal immigration to proceed as we have in the past. And many companies have had problems getting qualified legal immigrants, especially in the tech sector, coming in. That's not as much of an issue right now because the technology sector has slowed. These higher interest rates have really affected the technology companies. So I don't think there's such a big demand for these high-skilled immigrants from the tech sector right now. But we definitely do have a labor shortage in many other areas that may not need as many skills.
Vahan, do you see, as many economists are saying, that we possibly may be getting a recession either latter part of this year or early part of next?
Yeah, I'm actually surprised we haven't had a recession yet because the economy has slowed. These higher interest rates have taken a toll. I do expect to see an official recession. So remember, there are two definitions of a recession. So the classical definition is that you have 2 quarters of contraction, which we actually did have last year. But the National Bureau of Economic Research is actually the entity in the United States that has the authority to declare a recession. And as far as they're concerned, we haven't met the criteria for a recession. So what they're looking for is a general slowdown in economic activity that is dispersed across the economy and lasting for a period, more than a few months. So as far as they're concerned, we haven't satisfied that criteria. I think we've come very close, but I think we will eventually satisfy that, and I think we will see a recession.
If we do have a recession, what type of investments should a person be looking at to be able to maybe cover their portfolio?
Oh, that's a very good question. So I do expect a soft landing. I don't think we're going to have a very severe recession. I'm hoping that the recession would be temporary. So the kinds of things that should hold up better than other areas during recession are some of the stocks that represent things that people always need. Food, clothing, shelter. Some of the things that we refer to as staples. Um, However, you want to make sure that you have a diversified portfolio and you do have other things in there. So it's not just the things that are going to do well during the recession that you want in your portfolio. You also want things in there that will do well as the recession comes to an end. So there is an expectation right now, for example, that the Fed will have to decrease interest rates as we go to the end of this year. And of course, the stocks that would benefit the most from an interest rate decrease are the technology stocks. So even though they've done extremely well year to date, and as I said, I've been doing a little bit of trimming myself. These are stocks that I would also consider adding back into the portfolios if we do see a bit of a sell-off in those kinds of stocks.
I know you like NVIDIA. Is NVIDIA still one of your favorites? And if so, also, what other kind of stocks do you like?
Yeah, NVIDIA is definitely one of my favorite companies, but I would say that it's no longer one of my favorite stocks because it's done extremely well in a very short period of time. So I've actually been taking advantage of that by trimming NVIDIA. Yesterday, in fact, I started selling a little bit of NVIDIA. I'm not really planning to sell any more in the near future, but if I do see the stock continue to run up, I will do some more trimming there. I also had Meta that I had added to the portfolio. I added some Amazon. I added some Google. They've done all have done quite well except for Amazon. Amazon has really lagged, but you can make a case that it's really not a technology stock anyway. It's more of a retail company, and of course it has that AWS.
Yeah, I was about to say that the AWS is a big driver of their portion of revenues. Yeah.
Correct. If you take that out, the rest of the company is probably not doing very well at all. So that's a very important driver of their revenues.
Well, Vahan, right now we're hearing a lot about AI, artificial intelligence, and there are many, we're probably on the ground floor as we were maybe 25 years ago with the start of the internet, as we are now with AI. Are some of these companies that you just talked about, Meta, NVIDIA, and I know we talked about Amazon and AWS, but are some of those also at the same time good for getting in on the ground floor of artificial intelligence?
Yeah, absolutely. So Meta, NVIDIA, Alphabet or Google, and Microsoft, these are all companies that I think would benefit from artificial intelligence. And I think they've already benefited from the rumors of artificial intelligence. And I think they've run up tremendously based on that. That's why I think it makes sense to take some profits in that. I think artificial intelligence definitely has some tremendous long-term potential in terms of generating earnings for these kinds of companies. But a lot of times investors get ahead of themselves and they think it's going to be much bigger than they expect. It's going to take a while for artificial intelligence to really prove itself, to prove that it can actually be very profitable for these companies. Now, remember, in the past, we've had a number of innovations that turned out to be great. The classic example is the automobile. At one time in this country, there were literally hundreds and hundreds of automobile companies, but only a few actually became extremely profitable and lasted. So just because some company claims that it's in the AI business doesn't mean you should jump into the stock.
I'm reminded of the dot-com era of the late 1990s, where all you had to do is put a .com behind the, pet.com or.
Yeah, that's a great example. Yeah.
In your portfolio, when you're dealing like at Greenwich Wealth Advisors and such with your clients, do you like to have international stocks as well as domestic?
Oh, absolutely. So, in fact, I think you can make a case right now that international stocks are undervalued relative to domestic stocks. We don't get into the business of picking individual international stocks because it's too difficult to get the information you need. In the United States, the SEC is very good at collecting this information and making it available. It's not as easy for some of these international stocks. So we use, in all of our investing, we use a combination of individual stocks, all domestic, and also ETFs, some of which would be a domestic or sector-oriented, and some of them would be international. Two of my favorite are Vanguard ETFs. One is VXUS, which is it's an international ETF that excludes American companies, so you can be sure you're not getting duplication. The other is VWO, which is more emerging markets oriented. So it's looking at stocks from some of these emerging market countries.
The ETF that has a sector type would be a little bit better because you get a broader range of these international type of stocks inside your portfolio?
No, let me clarify. So I do use sector ETFs sometimes for domestic stocks. Mm-hmm. For example, XLF is an ETF I use for banking stocks. These are all American banks. But when it comes to international stocks, I'm not really looking for sector ETFs. I'm looking more for broad market ETFs.
Do you like bonds as well as equities?
Well, I hated bonds for many years. We had no bonds in our portfolios because it made no sense to buy bonds when interest rates were close to zero. Mm-hmm. Now I think bonds make a lot of sense. The yield on treasuries, especially short-term treasuries, has become so high that I don't think it's necessary to take any risks going with corporates. So we have been investing pretty aggressively in treasuries that have maturities of 6 months or less.
Before, let's say if the Federal Reserve continues to raise interest rates, would the yield on treasuries be going higher? And you know what also I'm thinking of, Vahan, is that if they do, would we be possibly seeing more regional bank problems? Because what the regionals were doing, they were taking their money and investing it in what they thought were secured treasuries, but at the same time, and if they had kept them for 10 years, they would be fine. But they weren't doing mark to market. Right. So if they do raise rates and yields will be going up, do you think that we'll be having more of a banking problem?
Yeah, that's a very good question. So the Fed has control over, direct control over short-term interest rates because they raise the Fed funds rate, and that really affects treasuries that are, of 1 month maturity, for example. So as a result, we've seen the short-term rates go way up. The long-term rates went up for a while, but recently they've come back down. But if long-term rates go higher, and they might if the Fed continues to be aggressive, then yes, you will see more trouble in the banking area. It's also wrong, in my opinion, to believe that it's only the regional banks that will be affected by this. What happened is that the Fed had interest rates at 0% for so long that people running banks were in a position where they couldn't earn any money. So they had to go further out on the yield curve in order to earn money. This is true of all banks, not just regional banks. So if interest rates go higher, I think you could see some problems in the larger banks too, because remember, a bank will fail if a critical mass of depositors suddenly decides to withdraw their money. Mm-hmm. And they were withdrawing their money for two reasons. They took money out of regional banks because they considered national banks to be safer. That was one reason. But another bigger reason is that all of a sudden they realized, well, wait a minute, why do I have my money sitting in a bank earning 0% interest when I can be in a 1 month T-bill and earn 5%.
There's a lot of commercial loans that are going to be coming due toward the end of this year and into early 2024. Well, regional banks hold most of the paper on these commercial loans, and with tenants not being in these having leases of these commercial banks, I'm assuming a lot of landlords are going to be rolling over these loans. Well, if they don't have the tenants, will banks even want to be rolling them over?
Well, yeah, I think those real estate loans, especially commercial real estate loans, represent a big risk. In many of the larger cities in the United States, you're already seeing a lot of commercial buildings that are empty. The pandemic convinced a lot of companies that they no longer need as much commercial real estate space. So as a result, they're not likely to renew their leases for as much space. And you could see many of these commercial building landlords eventually going under, and the banks that are holding those mortgages could also suffer. But big cities, especially big cities that have high taxes, like San Francisco and New York, they're having a problem.
Do you think it's because of COVID and people got so used to working from home? Do you think it's the crime problem, that people are not wanting to go into the major areas because of crime?
Crime is definitely one of the problems. I mean, we've already seen a tremendous amount of theft going on in many stores in the cities. We've heard a number of companies announce that they're going to shut down some of their stores in the inner cities. I think it was Target recently said that they lost approximately $500 million worth of sales due to theft. So this is certainly one of the problems. But the work at home issue is also important. Prior to the pandemic, we would have never imagined a situation where people could be so productive simply by working from home. In fact, in many cases, they're even more productive. If you don't have to spend an hour or 2 hours a day commuting, and you can just, go from your bedroom into the kitchen, have a cup of coffee, and immediately get to work, it really increases productivity. So with innovations like, with the computers we have and with video conferencing that we have, there's really no reason for a lot of white collar workers to go to a central location anymore. There are many jobs, especially in blue collar areas, where you have to show up in person and work. And as you may recall, Elon Musk recently said
I was about to say that.
He
Yep.
thinks, he thinks it's a moral and
it's a moral
certainly
issue.
unfair.
Yeah.
Yeah. And I think he's got a good point there. It really isn't fair that, some people have to show up to work and other people don't. And of course, for younger people, it's extremely important for them to show up in person and for them to be around other people in person. Otherwise, their careers may stagnate.
Vahan, that's an excellent point, especially for the younger worker. You want to be mentored by those who have been around a while to learn from other mistakes so that you don't make them yourself. And if the labor market is tight, then the employee would probably have more of a say-so. But if we start having more layoffs the way they are, then the employer would have probably more of a say-so.
Yeah, that's absolutely true. I mean, we saw for the last few years, for example, we saw technology companies doing things that, prior we would have thought was unthinkable, like allowing people to bring their pets to work. That would have never happened many years ago. But I think you're absolutely right. When the labor market loosens up a bit and people have more trouble finding jobs, they're going to have to do what the employer says. And most employers do want people to show up in person.
Right now, we're in the middle of the year. Do you think by the end of the year, let's say December 30th, by late December, do you think the S&P will be higher, or do you think that it's going to be as it is now, or do you think it'll be lower?
I actually think that most stocks will be higher. I'm not sure the S&P will be higher. The S&P, of course, is a market cap weighted index, and it's already run up quite a bit this year simply because the top 10 stocks or so have done extremely well. I believe Apple, for example, is 7% of the entire S&P. Other stocks have not done as well. So I do expect other stocks to do better between now and the end of the year. I do expect stocks in general to go up. The S&P may go up a little bit more but I expect to see bigger gains in things like, let's say, the Dow Jones Industrial Average, and even some of the small cap stocks, something like the Russell 2000.
I hope you come back.
Well, thank you very much. Thanks again for having me.
Thank you, Vahan. Well, if you have a question or maybe a comment about the show, we'd love to hear from you. Make it concise, make it piffy, and write us. And notice the new email address at andre@benecapital.com. So let's take a look at the markets heading into next week. But first, what stock index was first published on this day in 1896? We've got the answer, and it's coming up. Well, what stock index was first published on this day in 1896? The Dow Jones Industrial Average. It started off with 12 stocks, and it originally was went from 12 to 30, and it increased. But every one of those stocks no longer either exist or are in the Dow. General Electric, GE, was the last stock that was replaced in 2018 after 110 years. Well, let's have a wrap up on Wall Street. Yesterday was the 100th trading session on the street. And as my old friend Mark Twain used to say, history may not repeat itself, but it sure does rhyme. Well, according to Ryan Dietrich from Carson Group and a historian of the stock market, on the 100th day of trading of the year, which was yesterday, when the stock market is 7% or higher, which it was, the market at the end of the year is higher 9 times out of 10. Well, I'll let you know December 31st if it's still 9 times out of 10 or we have to lower those averages to 8 times out of 10. And that's a wrap-up on Wall Street Wrap-Up. Next week, we're going to be having a show you won't want to miss. State legislators are either legalizing marijuana or turning a blind eye. But just how dangerous is it in the long term for marijuana? Next week, we'll be talking with Dr. Kevin Sabet, who was the former White House National Drug Policy Advisor for 3 presidents, the Clinton, Bush, and the Obama administrations. You don't want to miss next week. And that's our show for this Friday, May the 26th. Our thanks so much to Vahan Janjigian for being our guest this evening. But as always, we appreciate you for allowing us into your homes tonight. Have a fun weekend ahead with the ones you love and a happy Memorial Day. I'll see you next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.